Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, sectors, looking for investment opportunities and sharing those opportunities with everybody in the community. I answer your guys' questions on the weekends, either a Saturday or Sunday Zoom call. You can write in your questions before the meeting if you'd like, or you can attend it and ask questions real time. Those happen Saturday mornings or Sunday evenings. And then I do a midweek update on what I think looks good for entry points throughout the markets. What you'll see is that there'll be, entry points in certain sectors for, I don't know, maybe 6 months to a year. And then every 3 to 6 months up to a year, it rotates into other sectors, other companies. Maybe a couple of years ago, it was gold senior miners or gold mining companies, producers. Now it's a little bit more speculative this past year or two. And then it switches to other sectors. So if you're interested in signing up and learning my strategies and approach, special the coupon code that you can use. That gives you a discount on both the monthly and yearly memberships. So starting with the Nas, he says, Dan, the group of 8 increased production ceilings, quotas, not actual production. Actual increase in production will be way lower. So a lot of people, they see the quotas being increased and they assume that production is gonna ramp up. So it says you wrote, so less oil is absolutely better, but does this mean that now even Saudi realizes we are already swamped in oil? He says the group has never discussed a higher amount. The media and its quote sources come up with the increase. The less doesn't apply unless you buy the media stories. The market is way tighter than the general sentiment. All right, so we've got quotas going up. Production may or may not go up. Media sources are just throwing all this crap out there to try to keep the price of oil down. And the market is way tighter than the general sentiment. Is that right? I don't know. I mean, that's his opinion. And when I look at the companies that I'm invested in the oil and energy service sector, they've already bottomed. They're already heading higher in a lot of them. I don't think I can go back and buy the bottom of those companies anymore. I think the bottom is in. Some of the companies that were in Canada, I just looked at year to date performance for a couple of them that I saw on Twitter. The year to date, they're up over 20% year to date. You wouldn't know that when looking at the oil price, but their returns are over 20% year to date return on oil companies with the oil price basically chopping sideways. So we'll see. We'll see what happens with the oil price. I'm kind of indifferent. It doesn't matter if we go up. It doesn't matter if we go sideways, or it doesn't matter if we go down. If we go down and I get better buying opportunities, I'll buy it up. If it goes up, well, my account goes up. I'm not 100% in oil. I'm not 100% in natural gas. I'm not 100% in anything. And if we have a slowdown, more than likely, gold and silver are going to go up. So if oil lags, then a portion of my portfolio is going to go up, 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 up. If gold and silver relax and oil starts to go up, well, then a portion of my portfolio is going to go up. I mean, and then when it averages out, usually I'm in a pretty big uptrend. And that's why I don't go all in on one sector. I don't try guessing the market conditions on the shorter term time frames. I look at the big trends And if the big trends say that precious metals are going to go up, and if the big trends and big patterns say that oil is going to follow with it, I invest in both. Now, could somebody get better returns if they could time the market? Sure. I don't know anybody who can time the market, though, with that type of precision and certainty. So what I do is I get 3, 4, 5, 6, 7, 8, 9, 10. Well, actually, it's probably more like 12 or 15 different ideas and sectors. Grab the best companies I can find and ride it during the bull market. So Dow Gold equals 1 says silver like you've never seen it. When $50 breaks, it could be the floor of the next secular, I think next secular bull market, not bear market. Anything below $50 right now is a gift. At the very top, silver goes up 50 plus in a matter of days. So what he did is he created 3 channels. He's got channel 1 where it was a peak and kind of a cup, and then the handle. We have another peak, cup and handle, and then another quote, what could potentially be a peak, and maybe we do a cup and handle within it. So when we look, each of these previous channel vertical height is 1,287%, both of them to the T. If you were to project that same 1,287% upward, you get a price of $620, roughly speaking. Is that going to happen? I don't know. I don't know if that's going to happen. It sure looks like it could. And I know that a 45-year cup and handle breaking is a big pattern, and it can produce very big moves. So I don't get too caught up on the price projection. Where I look at is, could this create a gigantic move? My answer is yes. Could it go to 620? Definitely could. Well, I want some exposure to that. And that's all it is. It's as simple as that. Big pattern creates big moves. I want exposure to big moves. The asymmetry is big. I want in on it. But there's the 3 channels, a potential price projection for silver. Factors needed to make money in the stock market by Walter Schloss. Let's go into this. Let's see what factors we've got here. So number 1, price is the most important factor to use in relationship to value. Try to establish the value of the company. Remember, just a share of the stock represents a part of a business, and it's not just a piece of paper. Use book value as a starting point to try and establish the value of the enterprise. Be sure that the debt does not equal 100% of the equity, capital, and surplus for the common stock. Have patience. Stocks don't go up immediately. Don't buy on tips or for quick move. Let the professionals do that if they can. Don't sell on bad news. Don't be afraid to be a loner, but be sure that you're correct in your judgment. You can't be 100% certain, but try to look for weaknesses in your thinking. Buy on a scale and sell on a scale up. Have the courage of your convictions once you've made a decision. Have a philosophy of investment and try to follow it. The above is a way that I found successful. Don't be in too much of a hurry to sell. If the stock reaches a price that you think is a fair one, then you can sell but of 10 because a stock goes up, say 50%, people say sell it and button up your profit. Before selling, try to reevaluate the company again and see where the stock sells in relationship to its book value. Be aware of the level of the stock market. Are yields low and PE ratios high? If the stock market historically is high, are people very optimistic, etc.? When buying a stock, I find it helpful to buy near the low of the past few years. A stock may go as high as 125 and then decline to 60, and you think it's attractive. 3 years before, the stock sold at 20, which shows that there is some vulnerability in it. And that's just looking at support levels. Try to buy assets at a discount, then to buy earnings. Earnings can change dramatically in a short time frame. Usually, assets change slowly. One has to know much more about a company if one buys earnings. And that's on the website, we buy assets. We use price to book and we use assets as a way to value a company. Listen to suggestions from people you respect. This doesn't mean you have to accept them. Remember, it's your money, and generally, it is harder to keep money than to make it. Once you lose and lost a lot of money, it is hard to make it back. Try not to let your emotions affect your judgment. Fear and greed are probably the worst emotions to have in connection with the purchase and sale of stocks. Remember to work compounding. For example, if you can make 12% a year and reinvest the money back, you will double your money in 6 years, taxes excluded. Remember the rule of 72. Your rate of return into 72 will tell you the number of years to double your money. Prefer stocks over bonds. Bonds will limit your gains, and inflation will reduce your purchasing power. And the last one is be careful of leverage. It can go against you. There it is. Those are the 16 from Walter Schloss. The most thrilling technical setup in commodities today. Grok, ChatGPT, and Claude independently analyzed silver's 15-year cup and handle pattern with gold at $3,900. The silver price projections, the 3AI model consensus. So what it has is the highest probability of a conservative bet on the price of silver. They have a price target of $60 to $80 an ounce. 2026 to 2027 is the time frame. It's a modest rally. Gold outperforms, is what it's saying. We've got the base bull, which is a probability of 25 to 35%, and the price target of 80 to 100. And that would come between 27 and 28. It breaks 50, challenges the 2011 highs, is what it means. And then aggressive is an 8 to 10% probability of $100 to $150 price target that could occur in 28 and 29. Retail mania ratio compresses. And that's what it has. Now, I don't know what this is using to determine, because if it says, well, we'll have a bull market, but we're going to hold gold at $3,900 an ounce, then maybe it's trying to predict or project the silver price off $3,900 gold. Another better bet would be, well, what if gold's 7,000 or 8,000 or 9,000 or 10,000? What would the silver price be? And I'm sure it would have very different silver price projections. I'm not a true believer in the AI models that we have today. They are highly influenced by the articles and opinions that are written in the market. So this is a very biased opinion using AI based off of everything that AI is learning from. And I think if anything, it's more of a reflection of the sentiment on silver today of anything. But that sentiment could easily change, and we could get way more bullish than what even these price projections are. But I'm sharing it because that's what AI spit out. Part-time trader, totally agree, Tavi, and this chart suggests that oil is going to boom versus the S&P 500. It says oil is going to outperform the stock market by a huge margin over the coming years. This is the U.S. oil divided by the SPX. We have a falling wedge ready to break higher at some point in the future. Where oil, coming from a ridiculously low ratio, could go way, way higher over the future. And he's got this being the projection move, the window of it going up, much like the 1970s. And this is Tavi. This is what he was responding to. It says, hard to ignore how cheap oil has become relative to a diversified basket of commodity producers that historically move in close correlation. So here's the correlation. Hard to ignore how cheap oil, okay, we read that. Commodities rarely diverge for long, and this disconnect suggests oil is amongst the most undervalued resources today in his view. All of this while U.S. oil inventories sit near record lows, and the Permian Basin has seen nearly a 30% drop in drilling rigs over the past 3 years. More importantly, keep in mind that oil is also facing one of the most extreme speculative short positions in history. And the top one, the white line, is the MSCI ACWI Commodity Producers Net Total Return Index. And WTI oil prices in barrels of oil is the blue line. Notice how correlated they were before, and notice the large disconnect today. Why does that disconnect exist? I don't know why. I don't know if it's Trump in there doing crazy crap with the paper markets, or his buddies doing it, or whoever. I don't know if this is a true disconnect and it's going to stay disconnected, which I doubt. Um, I think that oil is just lagging behind, and then it will eventually follow the commodity producers net total return index. That's my guess, but I am biased because I think we're entering a commodity bull market for a whole slew of reasons, and I think I have justification for that bias too. Coming back, Terry says if we go into a recession, that will be bearish for uranium, copper, and oil. This time next year will be the time to buy these commodities, says Terry. Now here's my thing, all right? A lot of people say this. They say if we go into recession, you can't do that. That is a fumble. You can't say if this X outcome occurs. That's not how I approach the market. What I do is I approach the market with an open mind. Okay, so I enter the market, I look at charts and patterns, and I say, okay, if a recession is coming, what should we see in the market? Well, we would see topping patterns. We would see rising wedges, perhaps shoulder, head, shoulder topping patterns, maybe double tops, something on the lines of that. That's what we should see. What we shouldn't see are fresh breakouts, because fresh breakouts means that the recession is behind us. It's not in front of us. So when I go and I look, here's copper. A recession looks, or a bear market looks like this. A recession looks like this. A recession could be here or here. Those are slowdowns. But what are we doing? Why is copper breaking out? Why is it going higher? If a recession is coming, why is that having the opposite signal? Okay, well, that's copper mining ETFs. We could also look at physical copper. Well, that's just breaking out. I mean, that is just freshly breaking out into new all-time highs here, basically. Is that what you see when you get, quote, if there's a recession? Copper's saying no recession. So you can't say if there's a recession and copper's breaking to new highs right in front of your face. You can't make that claim. You can't be like, well, if there's a recession, it's breaking out, guys. And then uranium would pull back. Well, what is uranium doing? Does that look like a recession there? Are you telling me that you are willing to miss the entire bull market of uranium's big move because you're afraid of a potential recession that has no indication in the potential equity markets here? Let me move this over a little bit here. Volume. Does that look like people are not accumulating it? Does this look like a recessionary setup? Does this look like a topping pattern? This is what it looks like to me. 1, 2 pullback, we're entering wave 3, and we just broke out. Do you know what wave three does? It launches. That's what wave three does. I'm not saying it's going to go up just straight. What I'm saying is you generally move upwards in a wave three in waves. This is incongruent to a recession call. Guys, go back to geometry. Remember you did your proofs? Or how about philosophy? How about some of those arguments that people make when you go into a debate or something? You can't say if a recession, but you have no signs of recession. That's like saying if Max Verstappen, he wouldn't win a title if he drove a Williams car. The problem is he didn't drive a Williams car. He drove a Red Bull car, which is a good car. And you can't pull like what these people are doing. You can't be like, well, if there's this, it doesn't exist. The charts don't say it. And this is my big disconnect between everyone in the market. They'll come up and they'll say like, oh, these leading indicators, and I'll say, well, how are people positioning? If people are positioning for the long side, they're using news to confuse you. They don't want you to participate in the bull run. They are going to have this climb the wall of worry. And everyone is worrying about a recession. And this is going to climb it right in front of your face. You're going to miss the entire bull market of uranium that started in 2020 on this bottoming pattern in a super cycle move all the way up to wherever it goes in this move. I mean, go look at a bunch of different commodities. Here's SLX ETF, VanEck Steel ETF. Steel's breaking out. Does that look like a recession? Now this, if this started doing this and started rolling over, this is recession talk. Hey, you know what? The yield curve is uninverted. It's uninverting. We're falling over. Things are selling off, and we're getting a pullback in steel, in copper. We've broken uptrend lines. Okay, I'm on board. Where's the uptrend line being broken? Oh, wait, we're breaking resistance lines. Long-term resistance lines that are from 2021 to 2020, about 4-year resistance line, and we're breaking out of that. We just broke out, and on high volume. You know what this looks like to me? This doesn't look like a recession. This looks like we are about to catapult into another atmosphere level above previous highs. And it's not just copper. Does REMX look like it's moving? Look at the volume accumulate this. Look at the volume and the move that is moving. Does that look like a recession? You know what a recession looks like? This. You know what recessions are not? This and this. So when you look at this, and we purchased the bottom here in REMX and all these other ones that are bottoming, and we're riding it on up. Am I worried about a recession? I can't tell you if a recession is going to come or not, guys. All I can say is that people are positioning in this quite heavily. And I don't know if they're going to do quantitative easing. I don't know if they have insider information of what maybe could come. I don't know. But people are positioning in this quite heavily. You look at SILJ. SILJ, now when you get into some of these recessions, 16 up. Now this year is a pullback. We had a recession in 2020. That's the recession there. SILJ, I don't know if would be a good one for this, but you could look at maybe XLE, which is trying to break out against resistance here. If we were in a recession, we would see this really start to dive bomb. Why is this trying to break upwards, not downwards? So we've got copper breaking higher. We've got zinc is breaking higher. And we can show zinc here. We've got bottoms and a whole bunch of other things. Here's zinc. Does that look like a recession? I mean, we're basically breaking out to the upside. I'm sorry, I just can't get on board with the recession calls here at this exact moment. Could it come in a year? It could. It could. But I got to see this stuff roll over, guys. I mean, there is something rolling over. What's rolling over is um, U.S. construction employment, and that is something that is um, a leading indicator for a potential slowdown. So here's all employees construction. You can see this starting to roll over. Now, this is going to have to turn. Here's a recession here. This is the big recession. This is the big one. It rolled and turned over in 2007, and it was coming down. This is when you know you've got a problem right here. Now, we haven't rolled over and made a big move yet, so that is something to watch, but it's not there yet. It could be, though. I'm not saying it can't be. And we have to see a negative reaction in copper and steel and some of these other ones to get me a little bit more worried. So yes, there's always the possibility of going into recession, but you can't use that. You have to go with what the charts are showing you. Another one from Dow, he says, think you've seen silver chart on the internet, think again. An epic silver fractal is playing out, and we are in the fun stage. And I think maybe he hopefully got this from me because I was showing a fractal overlay on this. It says not only is $100 closer than most people think, so is 300 and beyond. And that's that fractal of 7 being there and 7's here. So we have this nice big move up, a pause, and then another move up. And it's just a fractal overlay of the 1970s and the way that the pattern moved in relationship to how we're moving today. It's the same exact psychological imprint on this pattern. Logan says foreclosure crisis, they say, but there's no foreclosures. This is the loan to value ratio for U.S. mortgages is 44.2%. Incredibly low. And I don't think foreclosures are going to be a problem. So when I hear a lot of people, they'll say, well, the crisis is going to be like 1929 or the crisis is going to be like 2008. No, it's not. No, it's not. Those crises were driven by the real estate market and the loans going bust from residential real estate. And then the banks had to eat all those losses. So it was a massive destruction of currency creation because loans create currency. It was deflationary because those loans were going bust in both of those scenarios. Where are these loans? Are these loans in the room with us right now? Do the people who are stating these crises, do they understand what drove those crises? In my opinion, they don't. Now, could there be another driver of a crisis? It could, yeah. We could have a different crisis. Maybe it's a debt crisis. We go to hyperinflation. I don't know. That's a totally different crisis than the Great Depression and 2008 Great Financial Crisis. Tavi says, deeply stagflationary. The latest ISM services report was a clear display of the Fed's predicament. The prices paid component is now pushing toward the 70 handle, while employment has dropped well below 50. And remember, this reflects services, not goods. So on the goods side, which commodity prices help illustrate inflationary pressures continue to build and accelerate. So when they were talking about uranium, Terry above, and he said, well, a recession. What if we have massive inflation at the same time that we get a slowdown? And oil and uranium and copper and steel, they all go up. Is that a possibility? Could that happen simultaneously? I think it could. It's kind of what we're seeing. We're seeing inflation go up at the same time that the economy is kind of choking on itself a little bit. So I wouldn't sell my copper, I wouldn't sell my steel if things are freshly breaking out, or uranium. Okay, folks, oil on water increased this past week by 20.5 million barrels. I'm fully expecting Javier to spin some BBG headline with it. Let's not forget that inland inventories drew by 27.2 million barrels over the exact same week, mainly in Chinese Shandong, Japan, and SK, South Korea. This is just oil moving from origin to destination over a longer route. Net net, we are drawing non-sanctioned, non-Chinese inventory. So things are a little bit difficult to ascertain in the oil market. A lot of people are out. We're going to see these big inventory builds. We have a draw this past week. I don't know if we're going to see builds. Maybe Saudi Arabia is increasing quotas to increase production because we still have draws of inventory. So maybe they need to supply the market more to keep it in balance, which it's out of balance right now. So who knows? I mean, I'm reading vastly different information from media versus what I'm seeing in the background from people on Twitter. So I don't know what's right here. All I know is that I'm staying long. We've got breakouts to the upside in a lot of my favorite companies that are oil and gas producers. So I'm staying long, guys. I'm not getting scared out of this. Here's gold, silver, copper. It says off the record, in the commodity cycle, gold leads, then comes silver and copper, agribusiness, and finally WTI oil. When oil moment arrives, you want to be heavily allocated. The move is a tidal wave. So get ready. And again, silver's ripping, copper is just starting to break out, and oil is lagging behind these two, which will come after. Get ready. It's coming. If you're wondering where we are in the oil cycle, just look at, okay, I already went over this one last time. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Special is the coupon code. And that's all I've got for today. So we'll catch you next time. See ya.